Our market monitor is positive about more rallies in the stock market, but he's also telling his clients to reduce risk in their portfolios. He's Jason Pride, Director of Investment Strategy at Glenmede. Jason, nice to have you back with us. Want to get your
Thanks
take.
for having me, Susan.
Great to have you here. Want to get your take on these markets, and what are you going to be doing on Monday morning? Are you going to be buying more stocks?
Well, I think it's a cautious investment stance that we have. Really, we're looking at an environment where the Fed is really forcing investors to take risk. Markets are rallying probably more than the fundamentals actually reflect that they should. We're still in a good but not great growth environment. So we're wanting to take risk, but we're doing so in a cautious way. That means seeking stability, but still being an equity buyer through this period.
So some of the stocks that you have meet that criteria. Let's begin by just leaping in here. One of your choices is Philip Morris. I guess that's Philip Morris International as to be compared with Altria. Why do you like it?
So the main thinking here is we're going for dividends and stability. We're going for dividend growth. This is a 3% plus dividend yielder with a 10% growth potential in that underlying dividend. It's great when you can get that sort of an income plus the growth on top of it. It's a stable business. People's smoking habits, unfortunately, don't change through the times, and they also have a very substantial growth exposure. They have a large market going into emerging markets, and we think that's a huge growth opportunity for a lot of companies out there. The other two we're talking about meet that as well. Emerging market consumers are seeing 10 to 20% increases in their wages, and we know what consumers do when they make more money. They spend more money on everything from toothpaste to cigarettes.
Well, talking about toothpaste, you have Colgate on your list. That's ticker symbol CL on the big board. The stock was down today, but it's been up sharply this year. It's the same investment theme, right?
Very similar investment theme. We're going for stability. Toothpaste and dishwasher. This is your staples. You don't really change your spending on this, except you may upgrade as your income increases. And this is a company that actually has a dramatic amount of emerging market exposure, primarily in Latin America, but also in East Asia. That growth is fairly strong. The dividend is solid, and the stability is there.
Maybe we should have saved Colgate for the last, because you eat before you brush your teeth. Your last choice is Yum Brands. That people eating a lot of chicken over in China. Yum has had some problems there with some food safety issues, but you see that as a short-term blip on its particular screen, I take it.
Correct. Now, this isn't a perfect stability one. You're still talking about a retail franchise. There's more volatility to it. It's a bigger growth opportunity because their presence in Asia is a lot stronger. They're tied to that consumers a lot stronger. The interesting thing about Yum Brands in Asia is really the KFC brand. Unlike its less cleanly image in the U.S., its image overseas and the stores themselves are considerably better. They're actually considered a little bit upscale by comparison to what they look like in the U.S., and we think that's a great growth opportunity. Anything attached to that emerging market consumer is a good story right now, as long as you're not really messing it up.
Jason, we have less than half a minute. Just want to get your take on that debate that we had at the top of the program. Do you buy bonds? Don't you buy bonds? You said reduce risk in your portfolio. Where do you stand on that?
We're not a big bond fan right now, at least not the traditional bonds. We think that hiding in the bunker and putting your money in cash and treasuries is probably the worst thing you can do when the Federal Reserve is basically punishing those that want to be the most defensive. You can't be doing that. But at the same time, investors can't just be blindly buying equities. You got to take risk, but take risk selectively.
Okay. Jason, any disclosures to make on the three stocks you were recommending?
So the three stocks, those are recommended. They're held by our mutual funds. They're held by Glenmede. I do not own them personally.
Okay, terrific. Jason Pride, Director of Investment Strategy at Glenmede.